Volatility is not risk. Volatility and risk are two separate things. The reason I bring it up is as financial advisors, and I'm not sure what you do for clients, but this is for professional financial advisors, whether you're a financial planner, investment manager, tax attorney, estate planning attorney, anybody in our field that deals with individuals and families. I've heard so often over the last few decades that, oh, I can't invest in this or that. It's too risky. How do you define risk? What do you mean risk? And they say, oh, it moves up and down. And they're describing volatility. So just consider this a short refresher in the subject that volatility is completely different. Risk, by my definition and by the generally accepted definition in our industry, risk means risk of permanent loss. And volatility is price discovery. It's the idea that you have an asset that people in the market are trying to figure out what it's worth. If it's a stock and it's had consistent earnings for decades and decades, and all of a sudden they come out with a bad earnings quarter, now there's a little nervousness out in the world that maybe this company has lost a step, or maybe it's not worth what we thought it was. So this movement in the price, which is nothing more than you have a seller of a share, and then you have a buyer of the share. What the value is and the volatilities, it only matters what the buyer is willing to pay to the seller. And that varies. And it's not just with equities, it's with everything. It's with gold or commodities. It would be literally anything that has a market price. I remember when I was growing up, we lived in South America when I was a kid. We lived in Europe when I was a kid. We lived next to the border of Mexico at one point when I was a kid. I remember sitting in a coffee shop in Mexico with a bunch of locals, and they served us lunch. And at the end, they brought the bill, and one of our friends pulled out his wallet to pay for the bill. I saw him look in his wallet, and he had two kinds of money. He had pesos and he had US dollars. And I was thinking, gee, I wonder what he's going to use, because they'll take either one in many of these places in Mexico. And he paid in pesos. You know why? Because he felt the dollar was stronger. He had an opinion on one currency versus another, which one was more valuable. So he spent the less valuable one and kept the more valuable one. I remembered this my whole life as a professional, because what we're just describing right there are the currency markets. If you've ever wondered why the dollar is stronger than the currencies in South America or in Asia or whatever, the dollar is stronger than every other currency, frankly, in the world, except for in short periods of time, maybe the Swiss franc. But that difference between the currencies, they call it volatility, but it's nothing more than price discovery. I'm going to leave you with 3 points about volatility, just to, let's call it, give you the courage of your convictions, talking with clients about this, standing your ground. It's okay to tell the truth to a client in an effort to benefit them, which this kind of conversation really does help clients. I want to focus on 3 areas. Don't fear volatility, understand what the real risks are, and think long term when you're discussing this with clients. So don't fear volatility. Embrace the reality of what it is. If you've bought a quality investment, a quality long-term investment, and in the short term, the psychosis of the masses bring the price down temporarily, persuade your client this is a buying opportunity. You've got something solid. When it goes on sale, let's buy more. That's the thinking. And it's difficult to get some clients to that line of thinking, but it's worth the effort, because in the long run, the whole objective is clients just have 2 simple use cases, in my experience. They just want 2 things. They say to me, I have money and I want to keep it. And in a professional's translation of that means I want my real rates of return above inflation and taxes and everything else. I want to keep my money. I don't want it declining or melting away with inflation and reduction of purchasing power. Okay, so I have money, I want to keep it. The second use case is, and I have future goals that involve money and planning that I'd like to accomplish. So I'd like to keep my money. I have some goals I'd like to achieve. Those are the 2 use cases. There are only a couple of asset classes that will actually do that for you, and they both involve volatility. Now, everything has risk. There's just trade-offs of risk. And what we're talking about here is being able to have a skilled conversation with a client to get them to accept the real risks. They think if they're sitting in the bank or in a US Treasury or something like that, that they're safe. The people in our industry, we all know, they call it inflation. They use all this polite language and they call it, oh, inflation. What are you going to do? How are you going to fix that? It's unfixable. The reality is it's not safe that for every dollar you put in, let's say a US Treasury, yeah, you can buy a 10-year US Treasury. And 10 years later, if you put $100,000 in, or you put it in a bank certificate of deposit for 10 years, at the end of 10 years, here's your $100,000. You put in 100,000, you get 100,000 out. We're good. You're safe. No, what's really happening, if you look at the historical monetary inflation rate, which is about 7%, the reality is that in my whole lifetime, I've tracked this back to my great-grandfather who was born in 1850. It's certainly true during that period of time, 55 to the present. But the reality is you put $100,000 in, when you get $100,000 out 10 years later, you can buy half as much with it. The average decline is 50%. So for every dollar you put in, they should hand you back 50 cents, but they don't. They dress it up and they call it inflation, but in reality, what's happening is dollar in, you get the same dollars out, but those same dollars out, guaranteed, they can't buy the same amount of stuff in the world. They've lost purchasing power. The currency has been debased. They've just printed money beyond what we're bringing in revenue to the government. That's deficit spending. The impact on our clients is just the reality that we live in, which is if they think they're safe pulling the same amount of dollars out, they've just lost half their value of their money. So back to volatility. The first point is don't fear volatility. Understand it, embrace it. It's part of helping clients achieve their goals. They have to get comfortable with it with a portion of their assets. Number two, understand what the real risk is. I've just laid out to you what the real risk is. This is what, as professionals, we have to deal with all our clients to get the real rate of return required for them to keep the value of their money, the purchasing power, and achieve their future goals. We've got to embrace volatility and understand what the real risk. And the real risk is something that's a risk of permanent loss. That's real risk. In some, there may be risks that involve permanent loss. And I would say that's true with all asset classes, but it's not volatility, that's for sure. Make sure that you have clients clear on the fact that when they say risk, we have to talk about, are we talking about risk to your purchasing power? Are we talking about liquidity risk? We track 7 risks that are primary for our clients. Volatility is not on the list. So my third and final point is think long-term. Just markets move in cycles. Financial markets move up, they move down, they move up, they move down. But if you're investing your clients or if you're observing clients who are invested in a quality long-term portfolio, what you should be seeing over the long term is 3 steps up, 2 steps back, 3 steps up, 2 steps back. You're ratcheting up as the client's moving towards their objectives in the long term. Use that market cycle. When things are down, your job is to persuade your clients not to sell everything. Don't let an emotional panic ruin your entire quality long-term financial strategy. Embrace the market cycles and help clients understand that if you're holding quality assets when the markets drop, you're in a perfect position. It's a great opportunity to purchase more and create an even larger margin of safety when things continue to get back on track, as they always do eventually. So there's a lot of noise out there in the financial media about booms and busts. Of course, the headlines are always trying to grab clicks and trying to get the attention of your client, panic them, and clickbait to get them to read the articles that claim, oh, the sky is falling, beware of this, that, or the other. Your job as a financial advisor, no matter what end of this industry you're in, is to help the client use a cool head, be dispassionate, evaluate their situation based on the reality of the whatever financial markets they're involved in, and to separate volatility from risk in their minds. So don't try to predict the future. Focus on risk control. Be the person in the client's life that helps them manage risk. Risk is not even to be feared. Risk is to be managed. Anybody in a client's financial life that will raise their hand and offer to be the leader in their life, helping them to coordinate all of this and to think about this properly, if you'll be the individual in their life that will help them assess their current situation so that you can understand the risks that they're facing and help them manage the risk, to help them understand that there is no risk-free solution that will actually get them to their goals. There's only risk management. And with that, I wish you all the best, and we'll see you in the next video.